So, hello. How's everybody doing? Hope everybody's having a great day wherever you are, whatever may be doing. This is 50 Pips, rocking and rolling here, 9th of September, 2022. No trade calls, no recommendations, or responsible loan stuff because we're here for educational purpose only. So, here for another one of these live streams, as usual, pretty much once a month. Try and do these. Happy to take questions, go through any market action, go through anything anybody wants to discuss for as long as people have questions. If there's no questions, we'll shut it down early. So, hope sound is okay. Stefan, how's sound? And we can get into a couple of things here. Basically, right now, we've got a couple of Fed speakers on deck. We've got George and Waller speaking. So, again, we'd expect more of the same. No surprise. Asset prices lower, rates higher, as we were discussing in the past. So, again, let's see what gives. If anybody can confirm sound is okay, or I'm just going to have to go ahead, and if it's good, it's good. If it's not, it's not. Basically, last time we spoke, hey, Will, how's it going? Basically, last time we spoke, what we said was there are a couple of dynamics going on, but basically, the market seemed to be ignoring the fact that Powell and company kept on saying that basically they wanted asset prices lower and rates needed to go higher. And in that context, we said that basically having been looking for rates to move higher on this retracement, we said, any kind of move back into this 2.75, this is pretty much should be a layup for a move back higher, right? So the only trade, the most obvious trade across the board, thanks, Will, was to be short bonds, right? And here what we've had is basically a move right back into what we can consider here more neutral. I know some people are going to have a problem with the neutral comment, but basically, hovering around this 3.5%. Now, everybody all the Fed officials keep on telling us that we have to go to 4, hang around higher. So again, probably any kind of dip, unless something substantial changes, any kind of dips in bond in yield is going to be an interesting opportunity to get back in short bonds. But really, the quick move for now was done, right? And essentially, if you look at it in terms of ZNs, what we were looking at was basically this whole move flushing out, getting everybody excited on get long bonds. And this failure gave us ample opportunity to get back short, to look for a move back down into, essentially what the Fed was telling us. Now it gets a lot messier because basically either we're going to really cause a lot of pain, right? If we go back through that 3.5, then things get extremely ugly, or you would expect to see a little bit of a pause, a little bit of a tactical bounce, even if ultimately we're going to continue lower. And that's a similar situation that we have in stocks. What we were talking about on the ES, I'm just going to go through bonds and ES, and then if there's questions, we'll take them. I know we got the yen. What we were talking on the ES basically was the fact that, again, asset prices lower. We expected ES to go lower, but you had to understand that here, especially once we're in this choppy range, the risk was for a squeeze back into the 50 back of this move and the confluence of the 200 DMA, and that would be a nice place to get short. And so, that played out, and bam, here we're hovering around the 3,900. Now, what I've been discussing on Twitter a lot is, again, that here it's time for a little bit of a tactical bounce, especially if we couldn't get any traction back below the 3,900. Now, what's also interesting is, the dynamic around the max panic we recently saw. So last Sunday we had this heavy close on Friday, gap down, and we held and we attempted to rally. And that's where all the bulls said, okay, that's it. We're going back to all-time highs, rip them higher, rip them higher. And essentially the market just continued moving down in extensions, all these moves. And once we broke down below that gap down low and the 4,000 level, you see that every time we tried to poke, the ES tried to poke its head above, basically it was whack-a-mole action, right? And what we said is at that 3,900, it looks like it's time to try and get long for a tactical bounce. But unless it can get through this level, right, it's still just going to be a very shallow bounce. Now here, what's likely going on, we talked about the importance of where we were in the context and the calendar, where we're approaching quarterly expiry next week. And we said, all things being equal, you would expect to see some kind of a low set this week and an attempt to bounce all the way into OPEX next week. So that's next Friday. And for that to play out, especially with a little bit of juice, you need to get back above this this gap down level, which is essentially the 4,000 this week. And we've been tweeting about it. That's the bull bear line for momos and flows into OPEX. So here also, you have to think about traditionally the seasonals in September. It tends to be heavy, but you have a situation where we kind of go kind of choppy, then we rally up into OPEX, and then we sell off, right? And essentially, if you match the action this month compared to the seasonal pattern, it's pretty much spot on. And the peak usually should be next Thursday, Friday. So right now, the way I'm looking at it is, again, what's happening here may not have anything to do with sentiment flows, whatever. It may just be some OPEX flows going through. So the other level to keep an eye out for on the upside, and we talked about this a lot, this was the ping pong range, was the 4,200 and 4,100. So right now, as long as any dip into the 4,000 back inside this gap down low holds, our base case expectation is that we'll continue to squeeze up all the way into OPEX, trying to move back inside this choppy zone, which essentially is an amber zone, okay? It's chop. Right? What's interesting now with this choppy level, if you flip it onto the daily, you'll see that the 200 DMA is slowly coming back into this 4,200. So this is going to be an extremely important level for the bears to defend in terms of the 200 DMA, in terms of these series of lower highs, in terms of this range, which was extremely pivotal in the past. Right? So this is the key level. Textbook play, if this is a bear market, you would expect this to continue to squeeze up all the way into OPEX and then get sold here post OPEX and then start to sell off again. Now, one scenario which I don't see a lot of people discussing, which I think is important to keep in mind, is that, as always, markets can go up, market can go down, but markets can also go sideways. So here we've seen kind of like the Fed being extremely vocal about not being happy about this ramp up we saw back into the 4,300. And equally, we did get some noise, some soothing voices coming out when we were back down into these lows around that 36.50, right? So, there is a scenario where we spend a better part of the following months, unless something changes with the Fed, unless something changes in the data, with basically this high, 4,300 capping and this low for 37, 36 capping, and we see an awful lot of choppy action here. But as long as data continues to be strong and nothing has to change for the Fed, the main message is rates higher, asset prices lower, and that would mean dollar higher, and that would mean pain. And you would expect us to be tempted, or the market to want to come back down and test these lows. It doesn't mean we're necessarily going to break them. Again, also because at this point, 4%-ish should be priced in. But again, I don't want to talk about fundies and la stuff, because we don't know about the future. We just know about price. So shorter term, we know that we've got those bigger resistance at 4,300 and 36.50 holding. And right now, the importance is to understand how we're going to navigate this messy range. Hey Sham, how's it going? So basically here, 4,000 is pivotal, right? You would expect to see a sharp acceleration to try and test those 36.50s if we have day closes below the 3,900. And you would only expect the heavy pressure to come off if we really get a day close back above the 4,200. So anything inside here is very, very choppy, but the path of least resistance, we would expect this is to continue to try and squeeze into this range into OPEX, and then maybe ideally that offers up some nice selling opportunities. So that's the way we're looking at the ES bonds. We discussed that at the beginning of the session, and again, the thing to keep in mind here is that, the market's being fairly technical across the board, and it's really all the same trade, right? It's really all the same trade. So what you're seeing here is, risk is rallying. So equities are rallying. All the meme stocks are rallying. You've got Bitcoin's up 10% today. Everything's popping. The dollar's coming up a little bit. So, we saw that reversal, and that means the same thing. The dollar is coming off these highs, is trying to put in a negative weekly close. And if stocks can rally a little bit, you would expect this dollar to try and come back into the 10-day moving average. You would expect euro to continue to work off this failure to hold below the 1 mark, back to retrace the trend back into the 100 or the 200. You'd expect cable to hold and bounce a little bit. You'd expect Kiwi to hold here and bounce a little bit. But essentially, it's really the same trade across the board, with everything pretty much moving in sync. In terms of JPY, USD JPY here, my base case here is that I'm not really trying to make prediction of, could this go to 150, 160? Could this go back down to 100 or whatever? I'm just trying to be tactical, playing around the levels. And as I think we discussed last time, to me, the trades here are just to try and play either the squeeze Momo to the upside, or the failure or the stalls after the squeeze Momo dies out, right? So what you see here essentially is the easiest thing. I would just plot all the round numbers, and basically any move into a round number, and here we've got some plotted out, that fail, you try tactical shorts for the next round number or the next key support resistance. And any round number where we go knife through butter, you just get long, even if you're playing on the hourly close with a stop below the previous hourly, the one below the round number, and you're looking for a squeeze to continue into the next round number to the upside. I'm not making it, I'm not trying to make it harder than it should be. It's just all about Momo around those round numbers, and that's the way I'm looking at it. I have really no view. I would expect that sooner or later this will stall. You might get some kind of intervention out of the Ministry of Finance, but really, you can't play for that. You can't wait for that, because you don't know how, you don't know when that's going to come. And really, you should be worried, because they've been kind of talking about that all the way up, but they haven't done anything. So they're not going to come and save you, and it's not a repeatable long-term strategy. The best thing to do is to trade around support and resistance, in my opinion. And if you're not comfortable doing that, it's much better just not to trade it altogether. And in general, if you're not somebody who is solid with your stops or with your size management, I would just forget this chart altogether, especially if you're trying to short it, because it's the best way to get taken out to the cleaners. I think if you're solid with your sizing, with your stops, there are a lot of opportunities to play around those round numbers or whatever headline, if you're lucky enough to be in front of the screen. But they're not repeatable strategies. You can't bank on being lucky enough to be in front of the screen on a headline. If it happens, it happens. But yeah, and again, they've been talking about, worried about that they're more, it's always about rate of change, right? So you'll expect them to be more vocal when stuff gets out of whack very, very quickly, but you can't bank on that. It's not a tradable thing. So, but again, here you're seeing all the charts are moving in sync. And another very nice one here was the euro. We've been talking about this for a long time, and I can't remember if we mentioned in a webinar or here, but we said the same thing. We've been talking about the Fed is hawkish, and the market doesn't want to believe they're hawkish, and they're saying we're hawkish, we're going to raise rates, until the moment where they do, and then the market says, oh, what a surprise, right? And we said exactly the same thing is going to happen on the ECB, right? ECB is going to have to turn hawkish, they're going to raise rates, and then everybody's going to say, oh, I'm surprised, despite they told you. And here, the action, whether you're listening to what they're saying, what they're doing, or you absolutely don't care, it doesn't matter. Just look at price, right? Price is being very, very clear. Once we came here and we probed below the parity mark, it was just unable to attract new sellers at lows. It was unable to get a lot of traction. So here, especially after we broke down, we tried to hold and get back above the parity mark, and we came back down. See, this is a really important reference point, is you have this gap, right? This is what you really want to focus on. As long as we're pressing, then it's really heavy, but you see how we're coming back through that gap, we're trying to hold, and we can't get any traction. That's that classical, and I mentioned it on Twitter, it's that classical ball underwater trade, right? That you keep on pressing it. As long as you can hold it underwater, it's good. But once you let go, it's going to pop, right? It doesn't mean it has to get a lot of traction, but it's going to pop. And it's similar here, as we said, there's another one of those trades like the short bonds is going into the ECB. It looked very nice, came back up, retested, held, and then bam, right through the level, cleared all these stops. Right now, essentially, this is a chop fest, right? Very likely ECB is going to go 75 again, probably 75.50. Market sooner or later is probably going to realize, and we'll see a little bit more of a pop likely. But chances are, our base case assumption is still that if euro trades below parity, it's not going to hold below for a very, very long time. Here, broadly speaking, this is a very, very choppy zone. With the parity, with the mark being a little bit pivotal, and we need to break above this zone. Usually after the ECB decision, once you get trending, that trend tends to extend into next week, so we'll have to see what happens. But again, here on FX, it's the same. It's the same trade across the board, and right now it's going to be a fight between probably the two more hawkish recently central banks, which are the Fed and the ECB. But right now this is still in trend. Keep in mind that any bounce is still corrective, right? And you see how all these moving averages are in line, but we'll have to see what happens, right? But right now it's very hard to be short as long as it's poking its head above the one, because the risk is for a bigger pop higher, right? Doesn't mean it's out of the woods and it's going back to 140. No, but the more you hear people in general saying, Europe's going to die, they're never going to get the act together, they're never going to raise rates, Europe is going to freeze to death, who's going to be moving out of Europe this year because they're going to have no food, no heating. Usually it's a time to cover your shorts and, if anything, get tactically long. But again, it's the same trade across the board here, and similar on cable, similar on Aussie. So it's just a dollar trade, right? Now, one thing is to keep in mind going into next week, especially on the ES and on this equity squeeze, right, on this risk rally, is the big test is likely going to be on Tuesday when we got the CPI numbers. So you want to watch that. As long as the CPI numbers don't come in super hot, this squeeze should have a little bit more juice, and the OPEX flows should continue to be able to play, and we should continue to see this pop a little bit higher and the dollar come off a little bit more. What could go wrong? Well, in that scenario, CPI could come in super hot, but I would suspect that if it's kind of in line-ish or a bit soft, then it should help this dynamic to continue. But again, it's never a lock, it's never easy. What's my view on balance sheet tapering with the ECB or the Fed? I really have no view. I really don't care. I'm just trading the levels. My only view, if I have to say something on the central banks, is that they're going to be more hawkish for longer than people expect, most likely. And I don't think we're in a end the world scenario, but let's see. I'll just follow the levels. Yeah, you saw the covering happen. It's normal. If you were sitting on good profits on the short side ahead of the ECB, wouldn't you start covering? And those are usually very good tactical trades, right? When you've had a strong trend coming into one of these big meetings, you always get some kind of tactical covering, and it's usually nice to play for a little bit of a counter move, and it gives you the opportunity to try and get into trades where you can get in, take some off, try and cover your risk, lock in a little bit of profit on the trade idea as a whole, and buy yourself some optionality to stay on a partial position to see if you can get a little bit of a Momo push through that event or meeting. Sure. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? Yeah, here again, it's Friday. One thing I want to mention is that the last thing you want to do is, especially if you've had whether you've had a good week, a bad week, or a break, you never want to get in trouble on a Friday. It's just never good to lose money, but especially psychologically in terms of emotional capital, you don't want to be fighting until the close, defending a crappy position on Friday and go home a loser on Friday. It's just going to mess up your weekend. It's just going to mess you up to start the next week. It's better to just, take it easy and not get yourself in trouble. Again, comments, questions, welcome. I'll cover any chart anybody wants to look at. If nobody has any questions, I'm gonna shut the stream down. Let me think if there's anything else I'm looking at. Are precious metal having any play? It seems that no one is interested in precious metals are just, gold had everything in line to rally and it drastically disappointed. We talked about this a while ago, right? And we were wondering whether, with all the sanctions in Russia and stuff, it could mess with gold flows and just ruin it a little bit. I don't know. It's just a dog to me. Gold is just a dog, right? And here, what we've been doing is it's stuck inside this range. A lot of people that gave up on gold moved to crypto, and then crypto got shwabammed. But right now, it's just hovering here, right? There's not that much to do. And hey, always my pleasure, Shem. There's just not that much to do. I think right now, it almost seems like it's too good to be true for gold not to flush those stops below the 200 week. You see what I mean? Tessa, it seems like it's almost too good for it not to do it. Here, it just seems like we're stuck inside this range, and there's plenty of support, but equally there's plenty of resistance, right? It's kind of stuck inside this range. There's not a lot of interest, and it's just doing its thing. Now, ideally, also, if you think about it in terms of seasonal stuff, I wouldn't mind to see this stay heavy for a couple of months and then back towards the back end of the year, flush these stops in a very aggressive fashion and then put up a nice reversal candle. And at that point, especially towards the back end of the year, I wouldn't mind trading some seasonal longs, December towards the last Fed meeting of the year to ride them on to the new year. But right here, I don't really feel compelled to do anything. It's definitely not expensive enough to sell, and it's not really cheap enough to buy in terms of a tactical trade. If you're looking to get some gold in your portfolio, you want to have some precious metal exposure, sure, why not? But if you also step back a little bit, it's a really ugly failure here, right? It's an extremely ugly failure. Now, as long as it holds here, it could just be stuck. But if we get a flush of that 200 week, right, and you see no buying, this could be back down into, 1500s very, very quickly. So it's not a place where I'd want to be very loose with my stops if you're trying to get long, but the action looks fairly horrible, right? Fairly horrible. Hey, Daniel, how's it going? No, we haven't done oil. We can go through oil here. I mean, yeah, so hold on. So, yeah, Bitcoin, Bitcoin is just kind of like hovering here. It's trading with risk. Again, I don't think there's anything too interesting to mention on Bitcoin. Our base case assumption, again, if you looked at all those Bitcoin cycles, was that we could come back down to 1100. And right now it's hovering. It looks like it's trying to base, just like, again, it's following risk, like stocks are trying to base. And could this rally back into 30,000? Sure. I don't think unless it can get back above 30,000 that it's really out of the woods. You've got that gap here. So that's probably on a sharp rally. That's a level that will attract. But I think this is all a very, very big, very big chop zone, and it'll likely trade with risk. But, you know, if rates are going higher and asset prices are going lower, well, then very likely Bitcoin and all crypto are going lower again. Ethereum, I don't know what to say. Isn't there a merge coming or something happening soon? Again, I don't follow enough, so I don't know if I don't know what that means. I don't know what that's going to do. Here, it's just exactly the same as Bitcoin. So, you know, unless we get back above here or back below here, this is just a huge chop zone. So I don't really think I can add that much. In terms of crude, I mean, crude looks like crap, right? Really, let's be honest. The problem is it's very hard to trade. You're getting $5 to $10 price swings all over the place. It's just a hard one. Normally today, what does everybody always know? What does everybody always say? You never want to be short crude on a Friday, right? So you're seeing a little bit of a bid here. But right now, similar to gold, you had this big zone, right? And what we said is, once it was trying to bounce, we talked about the importance of the 195 zone, okay? Unless we said on this rally, be careful because this is a sell point, right? So unless crude can get back above that psychological 100 point, then it could get all perky again and squeeze and maybe try and make a run for those highs again, even though the action is extremely ugly. But here, as long as all the rallies to the bottom end of this range or into the 95 keeps on getting sold, our base case was that we could easily print back in the 80s. Now, if you look at this from a bigger picture also, it just looks like hell, right? It really looks like crap. So I think that here we're at extremely important psychological level that if it can hold the 80s, then maybe we're back into a new kind of chop zone, which is going to be 180. But if it can't attract buyers here and you get a nasty flush on a headline, then I wouldn't be surprised to see it go back into the 60s. Right now, it's still very messy here, but I would say day closes below the 80s, you could get a big flush to the downside. Day close above the 100, you could see a big squeeze to the upside. But as long as we're here, it's just messy. Not something I want to trade, really. But that's the way I'm looking at it. The problem is always the headlines is having to hold over the weekends if you're looking for a bigger, longer term position, right? So, but it doesn't look good, right? It doesn't look good. And you know, here everybody, since this is pretty much in line, once we had the Russia invading Ukraine, everybody got excited, and it's just been a disaster since then, you know, in a lot of commodities. And here there are a lot of people thinking that this is the ultimate layup and just completely get massacred, right? The same way as everybody were, for some reason, I don't know, lost their minds. And despite the fact that the Fed and everything was telling you that rates were going to go higher, the Fed told you we're going to raise rates, everybody thought it was a layup to get long bonds, and they all got massacred, right? But, you know, it is what it is. But I think here, both on equities long short, on bonds long short, the quick easy trades well, never easy, but the quick Momo trades are likely done here. We need some kind of a catalyst for the next big move, right? Because pretty much the market knows where the Fed stands. The market knows what direction the Fed's going to move. People have internalized this. So here we either we stay in a choppy zone, or we need some kind of very, very strong data or very, very weak data to come in and completely change the picture to force some kind of aggressive move. If not, likely we'll continue with these moves. They might take a little bit longer to play out, but don't expect any huge fireworks unless we see something change. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? CAD and Kiwi. Well, here it's very similar. I mean, dollar Canada is kind of stuck here. Also, you had some beautiful action at the 132 play out. You can look at this on a 1 hour too. Let me just get rid of these moving averages. Beautiful action around these round numbers, on the RBC. We came, oops, not what I wanted to do. We came back here. We flushed those stops after repeated failures here. And then we got that negative close, and we came all the way back to clear all that Momo to the upside that was building. But it's just the dollar trade, right? The BOC actually hinted that they could be kind of done for now. So you have to be like the RBA also. So they're clearly not as hawkish as the Fed or the ECB. So you want to be a little bit careful there. Right now, CAD, I'm not a huge fan because you also got, US risk that plays into it. You've got crude that's playing into it. But here, it looks like it's a slow crawl higher. And if we get this situation here where risk rallies, dollar comes off a little bit, this could easily come back down. But as long as the Fed continues to be a lot more hawkish and the BOC continues to say, be a little bit more prudent, then, probably path of least resistance is for this to continue higher as the dollar needs to take another leg higher. Would I be getting long here? No. I always like the extremes, so I'm much more partial to shorting failures here, shorting failures at new highs, or buying a move back into the bottom end of these range, back and all to these moving averages. And if you're looking at Kiwi's actually triggered a nice little long setup. And this is one of those where we talked about giving yourself some optionality for a pop. We came back down into, we're laboring here. It couldn't really attract new sellers. Then it flushed, it stalled, and here it flushed again. Actually, let me clear this. We flushed again where the dollar was turning across the board, and you got this beautiful reversal on the daily. These are very, very nice long setups, right? Especially for quick scalps, 1-to-1 risk reward plays or higher. And here the way you trade these, you get long, stop below those lows. You look to cover your risk, 1-to-1 risk. You cover 50, 75% of your position. You've locked in a winner for the trade. And then if you want, you can hold partial for a little bit of a pop back to the, the higher level of the trend to keep the trend into that 200. But it's messy, right? It's messy. And again, I think unless something really changes with the data on the central bank side, path of least resistance, even if we get a little bit of a weakness in the dollar and some of these risk currencies bounce, is especially the ones where the central banks aren't too super hawkish. They're probably going to get sold again. It's messy. FX is a little bit messy here. Or again, especially this year, we've had so many nice trades on the indices being extremely technical, respecting reference points and round numbers so beautifully, right? And you've had some really nice swing trades set up on the bonds, fairly clear, right? That I felt less compelled to be aggressively trading FX, or at least this is one of the years in the recent past where I've probably traded the least amount of FX, simply because the opportunities on the indices or on the bond side have been so much more interesting, both in terms of levels, both in terms of technicals, and also in terms of bang for your buck for the moves, right? And right here, you could also see, we talked about at the beginning of the week, where the VIX was pressing in 27s. It really looks like, and especially if this move into OPEX plays out, we'll see it smash back down into 20, right? And you're seeing it's been, you've had a VIX smash all week pretty much. Well, after the initial pop, Wednesday, Thursday, Friday, you just, that's the move. That's the move. Those are the seasonals. That's what's trying to play out. Is it going to complete, like we said at the beginning of the webinar, of the stream? We don't know, but you have to favor, at least your base case assumption is always worth going with, what usually happens in this context if you've been watching the movie or doing your homework. That's all. Okay. Any comments, any questions, any chart we haven't looked at, anything anybody wants to discuss? And, you've seen the same dynamic across the board. So even if you're looking at Euro stocks, right, we had that gap down, they tried to hold it, and then bam, we're through. So it's really, this week has really been the same move across the board, and it's not uncommon to see this play out this way, especially a week before OPEX going into a quarterly expiry. Okay, guys. Well, listen. I wish everybody an awesome rest of the day. I wish you an even better weekend and a fabulous time until we see each other again here on these monthly live streams. Thank you for showing up. As always, if you like them, don't hesitate to share them or like them. And that's it, guys. Over and out. See you guys soon. Take care. Bye-bye.